Hello, everyone, and thank you very much for taking the time to join us on this webinar. My name is Paul Sutton. I'm one of the partners at LCN, and the focus of this webinar is managing legal implementation risks in transfer pricing. In other words, best practices for multinational groups in terms of managing their intercompany agreements, focusing on the transfer pricing aspects of intercompany agreements, but also we'll talk about the other functions that they perform as well. So the agenda for today is on the right-hand side. So we'll go through the basics of what intercompany agreements are and why they matter, and also some common mistakes. We'll go through a brief recap of OECD basics as regards what the OECD transfer pricing guidelines say about intercompany agreements and how contractual allocation of risk fits into the transfer pricing analysis of transactions. And we'll give a very brief recap on recent international case law developments concerning agreements. We'll then talk about the wider aspects, the wider roles that intercompany agreements play. And then section 4 is really the meat, because that's diving into the practicalities of what approaches can groups take to actually manage their intercompany agreements and maintain them in an audit-ready state. So just a couple of housekeeping points. We will have time at the end for questions. If you want to use the chat function or the Q&A functions to enter questions as we go along, please feel free to do that. And we will circulate the slides after the event. So I'm going to hand over to my colleague Andrew just to introduce himself and to explain who we are and what we do.
Thanks, Paul, and hello, everyone. It's really good to meet you all. My name is Andrew Spires. I'm a director here at LCN. For those of you who don't know, or maybe for those of you who need maybe a little bit of a refresher, LCN is an international law firm, and we specialize in the legal implementation and design of transfer pricing. So what we do is entirely complementary to the services your TP advisors provide and what your TP function does. By that, what I mean, we don't advise on tax, we don't advise on transfer pricing, we don't prepare kind of benchmarking studies or anything like that, but instead we design and prepare the agreements to properly legally implement TP policies. By way of background, we are all corporate lawyers by trade. That has some benefits, as it allows us to kind of take a little bit of a holistic approach to our work, as we're kind of aware of the wider corporate considerations in play. But more importantly, we speak the language of transfer pricing, which is clearly very important if you're going to be preparing the documents capturing these policies. We have clients all over the world, and we work with TP advisors all over the world. You can kind of see on this slide a selection of the TP advisors we work with. You may see your own advisors there, but even if not, it's quite likely that we may have worked with your advisors in the past and we just couldn't quite fit them on the slide.
Great. Thanks, Andrew. So before we dive into the first section, which is what ICRs and ICAs are and why they matter, Sean, would you mind just launching our polling question? Because it would be great just to get an indication of who's with us today and what roles people perform. So yeah, if you wouldn't mind, please do fill in this form to identify which of the following best describes your role, your current role. And I can see already the results coming through. So majority right now seems to be in-house tax or transfer pricing, but we do have various advisors and lawyers on the webinar as well. So you are all very welcome. Let's start here. So what are intercompany agreements? I guess slightly obviously, they are legal agreements which document transactions between group entities. It's probably worth mentioning, so there is this idea that intercompany agreements are not genuine agreements or they're somehow artificial because they are between related parties. But actually, that's a totally false assumption, because when you apply a legal entity perspective, a corporate law perspective, the fact that entities may be members of the same group or may be under common control, it doesn't detract from the fact that the individual boards of directors of each entity needs to concern themselves about the commercial terms of intercompany transactions. So we're talking about genuinely legally binding agreements. As we'll explain, intercompany agreements actually make up the backbone of internal accountability and external compliance in relation to intercompany transactions. And they, in effect, they create and document the building block for transfer pricing compliance. And the reason for that is obviously the foundational principle behind transfer pricing is the arm's length principle. And that relates to comparing controlled transactions with uncontrolled transactions. And obviously, as many of you will know, that's called comparability analysis, but you can't even start on that until you've actually defined what is the transaction involved. And if you haven't been able to express it in commercial terms and legal terms, probably means that you haven't even got out of the blocks. You haven't even started in terms of analyzing the transaction for TP compliance purposes. And as we'll explain in more detail, intercompany agreements are actually a key tool for controlling tax risks, transfer pricing risks, and legal risks across borders. So I'm going to hand over to Andrew just to talk through some common errors. I think, Sean, I think we're completed on that poll, so thank you very much on that. Sorry, over to you, Andrew.
Thanks, Paul. So as Paul said, the purpose of this slide is just to kind of flag some of the common mistakes and errors that we see quite regularly when it comes to intercompany agreements. I don't propose to kind of go through each of these line by line, but maybe just pick out a few that I would consider to be maybe the most prevalent. You may, in your own kind of roles, have come across some of these issues in the past and maybe have had to deal with the fallout or maybe the ramifications of some of these errors in the past. But starting at the top and kind of a fundamental one really, simply having no intercompany agreements or maybe having transactions which are not properly documented. So what I mean by that second half is, yes, we have some intercompany agreements, but we also have these other transactions and there is just no documentation for any of those. We often see a contradiction or a conflict between what say the intercompany agreements say, as opposed to what the transfer pricing policy says, or maybe a conflict with what the actual business operation is. We will regularly see intercompany agreements with no pricing provisions, or I would say more commonly, the agreement simply refers to this kind of nebulous concept of a quote arm's length price, end quote. So that sounds fantastic in principle. It sounds like it'd be really useful and flexible, but fundamentally it does not work from a legal perspective. We will see unnecessarily long or complex intercompany agreements. And I think this can arise from kind of various sources, but I'm sure a good number of you have maybe asked your legal teams to prepare an agreement for you, and you maybe explain to them kind of the arm's length principle. And they have quite understandably reached for a third-party agreement to use as a base for their work. And I do stress that is a very understandable thought process, and I'm not looking to kind of indict that thinking. But in our experience, the output from that process certainly doesn't deliver what we would consider best practice. And invariably, that document will be too long and include a large number of kind of superfluous provisions, which are only ever going to count against you if the document is ever looked at. And then finally, a common issue, which I feel like I'm seeing at least increasingly regularly, I'm currently dealing with this for a client, is that there is the issue of kind of fraudulently attempting to backdate agreements. So as I said, this kind of a routine issue we are often parachuted in to rectify. And for the avoidance of doubt, this is a situation where, say, I sign an agreement today, but I then date the document with an earlier date. That does constitute a fraud. And I think when people do it within the transfer pricing world, I don't think they appreciate necessarily the seriousness of what they are doing. And I don't think they're intending to commit fraud, but fundamentally that is what it constitutes. And it's a tricky one because ultimately there are ways to deliver the same outcome in principle by having kind of earlier legal effective dates and all this other stuff. But maybe we can touch upon some of the mechanics of that functionality later on in the session. But to give you a flavor, and before we get to that, I'm just going to pass back to Paul so he can talk you through just a couple of the kind of typical consequences that can arise from these errors.
Yeah, right. And so you'll see at the top of the list is actually not a transfer pricing point. It's a corporation tax deductibility point. So we got cases like Aspro in the US, and there was a very similar Spanish decision where effectively, it was no ICAs, no corporation tax deduction for the relevant payments. So in the Aspro case, this related to purported management fees that were paid by the US entity to related parties. And unfortunately, the taxpayer was unable to evidence the nature of those payments, and therefore the corporation tax deduction was denied. And we're aware of various tax administrations, including, I guess, Nordic European countries and Mexico and so on, which apply a relatively harsh rule, which is that if a payment is not made on the basis or in accordance with a legally binding obligation under a contemporaneous agreement, then the corporation tax deduction will routinely be denied. So that's one implication. The other implication is that fundamentally the transfer pricing analysis or the benchmarking might actually relate to the wrong transaction. And we'll come on to this when we do the mini recap of what the OECD transfer pricing guidelines say about intercompany agreements. But if your TP analysis refers to one particular type of economic transaction and your agreements describe the transaction in different terms or deals with IP differently or contains a different risk allocation, then actually you've wasted your TP compliance costs because you've actually benchmarked the wrong transaction. And so what the lesson from cases like Coca-Cola and SingTel and so on is that groups actually do need to make sure that their agreements align with the transfer pricing analysis of the wrong transactions. And then obviously it's not just transfer pricing, it's not just corporation tax deductions, but we'll come on to the wider list of stakeholders on a later slide here. The final thing that I wanted to flag, which is towards the bottom of the right-hand side, is it's just the fiduciary obligations point in terms of directors. And I think that obviously that particularly applies to situations where groups may find themselves in a financial distress situation. And the fact is that if that applies and various members of the group do find themselves in insolvency processes, then generally speaking, the insolvency practitioners or liquidators or whatever will have a duty to investigate related party transactions and the conduct of directors in approving those transactions. That's another driver for making sure that everyone is protected and transactions are created in a way that is commercially rational, so it makes sense, is something that can be properly approved, and it is documented accordingly from a legal perspective. So we're going to move on and just do the mini recap on OECD basics and recent international developments. So briefly, in terms of, well, what are the requirements as regards BEPS compliance as regards agreements? So as we all know, the master file must contain a list of intangibles that are important for transfer pricing purposes and which entities legally own them. So there's this misconception that transfer pricing just concerns so-called economic ownership. That is not the case at all. So the master file needs to be specific about the categories or types of intangibles that are relevant and also the legal rights that is specifically provided for. And the master file must also contain a list of important agreements related to intangibles. So that's not just R&D agreements or license agreements. It can also include distribution agreements because often IP is one of the key assets or the key subject matter of distribution arrangements. And of course, OECD compliant local files must contain copies of all material intercompany agreements. And in case you're wondering, for the simplified methodology for low value added intra-group services, in other words, the cost plus 5%, actually written contracts, so signed and dated intercompany agreements, are a key part of the documentation for that. And the reason for that is partly because the agreement actually demonstrates the fact that the taxpayer has chosen to adopt this simplified approach, but also the agreement explains how the taxpayer has applied that approach. So, for example, which costs are not subject to the markup because they are pass-through costs, and what the allocation key is in relation to the allocation of those costs to multiple service recipients. And as many of you will know, that question about pass-through costs and defining what they are, and also how the allocation keys work, that can be at least as material, if not more material, than the actual cost plus percentage. So it's just to reconfirm that actually agreements are at the heart of how this system works. So just to drill down a little bit more in terms of the OECD view, the OECD guidance on the role of agreements. So here on the left-hand side, we've paraphrased the 6 OECD steps for delineating or analyzing the actual transaction with respect to risk. And you can see that the first step is to actually identify, well, what risks are we talking about here? And it's the second step, which is to determine how those specific risks are contractually assumed by the associated enterprises. And I think what's fundamental to understand here is you don't get to benchmarking your pricing until step 6. So if you haven't understood what are the actual risks that we're talking about here and what's the current status in relation to the controlled transactions as to how those risks are dealt with contractually between the parties, until you've got clear on those 2 points, you can't actually go ahead and apply benchmarking and filter out comparables in relation to your pricing of the transaction. And then just looking at the right-hand side of this slide, we've included an extract on the role of contracts and contractual assumption of risk, and the fact that the contractual terms, so the terms of intercompany agreements, is a very important part of the tax administration's transfer pricing analysis. What's also clear from the bottom section highlighted in yellow is the timing aspect. In other words, this is saying risk, the concept of risk, only has a meaning where there's uncertainty. There's no uncertainty in the past when risk outcomes are known. And therefore, allocation of risk, in order for this to be effective and robust, it needs to be on a forward-looking basis, so ex ante basis. And this is reflected in the rules of various countries such as Germany, which take a rigorously ex ante or in advance view of the role of agreements and allocation of risk. Just to give an example, so this example is a mini case study which is literally cut and pasted from the 22 OECD guidelines. And what it illustrates is that the presence or absence of one clause in an intercompany agreement can have a 20% difference in the arm's length profit margin that the relevant entity should earn. In other words, as reconfirmed by the recent UK guidance last year, contractual allocation of risk can have independent value. In other words, value independent of functions, which means that identifying the functions performed by entities, yes, that's important and a key part of TP analysis, but you can't actually delineate the transaction until you've understood what the contractual terms are. And just to explain a little bit, what does it mean by buyback clause? So this refers to a situation where you've got a principal which is appointing a distributor. The principal is saying to the distributor, please could you hold stocks of our products, but don't worry if you can't sell them because we will buy back any unsold stock at cost if you can't sell it within a reasonable time. So this is a buyback clause, and what it does is it moves the inventory risk from where it would otherwise sit, which would be with the distributor. It moves it back up to the principal, and therefore it de-risks the distributor and therefore reduces the margin which that distributor should earn on an arm's length basis. So finally, in terms of our brief overview of recent developments, I'm not going to go through all these examples. Most people, I believe, will be aware of the Coca-Cola case in 2020, so the US tax court decision, which I think was a classic example of a total mismatch between what the agreement said and what the transfer pricing analysis assumes as regards the ownership of intangibles. And the one-way street refers to the US rule that actually the taxpayer doesn't get to bring economic arguments to overturn its own agreements. It's only the IRS that gets to do that. Aspro, I've already mentioned. I just wanted to single out a couple of others. So JP Morgan was a UK VAT case, but it was very similar. In other words, what the tribunal said to the taxpayer was, sorry guys, you had complete freedom of choice as to what agreements you put in place. And having exercised that choice, you don't get to bring additional consideration and cause us, the courts, to ignore the terms of the agreements that you created. Germany, it's worth mentioning. So I've touched on before the fact that they take a strict ex ante approach, and one of the distinctive features of the 2023 guidance was reaffirming that the relevant point in time for applying the arm's length principle to a transaction, it's not the time when the transaction was performed. It's not the end of the financial year. It's actually the point in time when the contract was concluded. And that strict approach has been reflected in the new matrix regulations in Germany, which took effect as from 1st of January this year. And that means that taxpayers automatically have to provide an overview matrix of intercompany transactions, so automatically on following inception of an audit. And that summary information regarding controlled transactions needs to include an explanation of the contractual basis of transactions. So this is just part of this sort of general tightening up of governance as it applies to the legal aspects of intercompany transactions. So let's move on and talk about the wider aspects of intercompany agreements. Andrew, perhaps you could take us through some of your thoughts on this.
No problem. So the purpose of this really is to highlight that intercompany agreements are not prepared in a vacuum. Because of that, we would always encourage kind of a holistic approach to the agreements, ensuring that they take into account non-legal and non-transfer pricing considerations to ensure that they work in the round. Things like import duties, things like regulatory considerations and VAT. You'll have heard Paul mention the JP Morgan case a few minutes ago, and that's a prime example of where JP Morgan did not properly take into account the wider aspects of the agreement, in this case in relation to VAT. And the net result of that was that the courts deemed that VAT was chargeable on the whole amount of their intercompany fees. So it really shows and demonstrates that how important this stuff is. And it's not just looking at these things just through a kind of with the blinkers on from a transfer pricing and a legal perspective. And if you do that, the implications really can be quite serious if they're not properly thought through.
Yeah, absolutely. So one way of looking at this is that the role that intercompany agreements perform is that, in effect, they're the central source of truth as regards the nature and terms of a transaction. And they provide a reference point for getting the holistic cross-functional input in relation to the transaction design. So as Andrew mentioned, as exemplified by the JP Morgan case, withholding taxes is a case in point, because very often from a transfer pricing perspective, it would actually look at the overall net position of, say, the tested party, maybe the distributor, in relation to a bundle transaction. But actually for withholding tax purposes, it may be critical to separate out the different elements of the intercompany payments as regards which related to services, as regards license, as opposed to license fees for IP, and even within the IP bundle, whether they related to patents or trademarks and so on. That role of intercompany agreements as the central source of truth is subject to one important proviso, which is that's only going to be the case if the agreement actually reflect the conduct of the parties and reflect a commercially rational transaction. So really, that's the task that we are facing together, which is let's design commercially rational transactions in advance. Let's make sure that they've got the right stakeholder input, implement them legally, operate them in accordance with the transfer pricing policies and the agreements, and then report on them accurately after the event. So really that's the game that we are all playing in order to minimize risks for the corporates involved. So we're moving on to the meat in terms of practical approaches. Before we go here, I'd like to pause and ask people to reflect on the state of their intercompany agreements. And Sean, would you mind launching the word cloud question here? And this is not something that we've tried before on webinars, so I'll be really interested to see how it goes. So the question is, how would you describe the state of your ICAs for the preceding financial year? So if you're on a calendar year basis, how would you describe the state of your portfolio of intercompany agreements for financial year 2024? So please, and just reading these on the screen, it just brings up the comments of the US tax court in Coca-Cola, which was outmoded, inconsistent. Not one of the group's intercompany agreements referred to the 10-50-50 profit splits that the group was claiming. Cool. So maybe while other comments come in on this, Andrew, could you sort of take us through the recommended approach in terms of designing and implementing agreements?
Absolutely. Sorry, I'm smiling because one of the responses was rapidly outdated, which I really liked.
Yeah.
Anyway, so onto this slide. So this is effectively how we would kind of recommend the legal design and implementation of transfer pricing is approached from a kind of a best practice perspective. So step one is all around scoping. Now this involves understanding in principle the various transactions in play from a legal perspective. And there may be various transaction types in play at one time. So we could have IP licenses, we could have the provision of services, profit splits, cash pooling, whatever it may be. Fundamentally, this step is all about getting clear on what those transactions are. And now in order to achieve that, we would always recommend that you pull together a matrix of the transactions. And I'll come to that in a little bit more detail on the next slide. But that is certainly what we would consider to be the best practice approach. Now at the step one stage, it's also important to understand, firstly, what financial years are we catering towards? And are there any deadlines in play? Ideally, this work is front loaded, but to the extent there are tight deadlines in play, let's get them on the table so that everybody is making sure that we're going to hit them and working towards them. Now, step two is effectively where you review all this understanding of the transactions that you established in step one against the TP documentation and the related documentation from a fresh and kind of legal perspective. So the purpose of this really, as we see it, is effectively kind of kicking the tires to see if everything that you've established in step one in terms of what the transactions are aligns with what the TP policy and related document says. A typical example of something that maybe we would often see and spot at this stage would be in relation to intellectual property. So it is quite common for example, the transfer pricing policy to treat intellectual property in a certain way. The accounts may treat it in a completely different way, and different again, the actual legal position may be something else entirely. So it's at this stage, at step two, that we would always recommend that all these types of issues are obviously identified and then pinned down with any additional due diligence required being undertaken before you proceed any further. Step three, arguably where the magic happens, in a sense, that this is where we would recommend that you start drafting the agreements. And the one thing I'd note here is that notwithstanding that this entire process is designed to output a reliable, high quality intercompany agreement, it's not actually until step three that we recommend putting pen to paper, which hopefully kind of identifies and emphasizes really just how important those two preceding steps are in ensuring the quality of the output. So as part of the drafting process, we'd always recommend that kind of various stakeholders are consulted and are feeding into the draft, TP advisors, regulatory, whatever that may be. Now, in terms of what the agreement should be, clearly it needs to be legally binding. It needs to be unambiguous and obviously aligned with the group's transfer pricing policy, as well as its actual business operation. And obviously those latter two should align amongst themselves. But in our view, the agreement should also be written in plain language and be kept as short as possible without sacrificing legal certainty. And that's the real crux there. And in my view, kind of the gold standard here is that the agreement should be such that you can put it in front of one of the guys who works on the operational side of things. They can read through it, they can understand it, and they can tell you confidently whether it is reflective of what is happening on the ground. And if the answer is yes, fantastic. But if the answer is no, the agreement should still be clear enough in this draft stage that they can articulate to you why. So that's kind of what we're aiming for with this step. Step 4 is all around finalizing the documents. So obviously you need to take on board any feedback from the various stakeholders. And it's at this stage we'd also recommend that the kind of the non-transfer pricing and the non-legal considerations, which I mentioned earlier, are taken into account. The things like VAT, import duties, withholding tax, etc., in order to ensure that these agreements kind of have that kind of desired cross-functional approach, and they're not just working in the vacuum of transfer pricing. If localizing is required, it's at this step that we would recommend that these actions are kind of implemented. It might be that certain of the agreements need to have a different markup for different jurisdictions. It might be that we have some translations needed. I know I've been working on a lot of projects recently where in China and India, we've almost had to create a sub-variant of the agreement, which does not include certain kind of pricing provisions and mechanisms which the relevant revenues in those jurisdictions are pretty opposed to. So if anything like that, it needs to be done, it's at this step that we would recommend that is implemented. And then finally, you have actual implementation of the agreement. So clearly you need to get the document signed. We often project manage these signatories for clients where there is a large number, particularly where there's a large number of signatories and group entities, etc. And I think sometimes that almost becomes a bit of a part-time job because it's quite an expensive piece of work. But it's also at this stage, we would recommend that kind of a board briefing note is put in place. And this is a document effectively signed by all of the signatories to the intercompany agreements, and it explains the rationale behind the project. Now, that's something that's firstly very useful to have when it comes to audit. It also helps kind of protect against the issues that can arise from kind of corporate memory loss. And I think it's also underappreciated in the sense that it actually works to kind of ensure that the relevant directors are satisfying their respective duties when it comes to approving these arrangements. And you'll have heard Paul talking earlier about actually the potential consequences of kind of breach of these fiduciary duties, particularly arising when you've got an insolvency situation, is personal liability. So we would consider best practice certainly to involve putting in place documentation to try and defend against that kind of thing. And the final thing I'd say on this slide is you'll note that we have kind of artistically represented the structure with an infinity symbol. And this is just really to reinforce that obviously it's important to keep on top of transfer pricing, you try transfer pricing positions. And we'd always recommend that that's kind of revisited at least every 12 months. But this entire process needs to be kind of revisited whenever there is a change to assess whether an amendment to the underlying documentation that you already have in play needs to be implemented. So we can move on to the next slide now, Paul, because I said I'd jump into a bit more detail on the matrix. So this is an example of one of the transaction matrix that we would use. Now, fundamentally, the format of this document does not really matter. Ultimately, it is all about getting granular on the transactions themselves. As I said, we'd always recommend that this is used to kind of map out the transactions in step 1 of kind of best practice. And it should serve to map out the transactions and therefore include details of the transactions as well as details of the relevant entities in play. And it should almost become this reference point against which changes are measured going forwards, against which the TP policy and the TP report is measured to ensure that there is that alignment from a transfer pricing and a legal perspective. Now, one of the things I would note actually is that we recommend mapping out the various transactions separately. And that's notwithstanding that certain of these may well end up being grouped into single agreements. By taking a kind of a transaction by transaction basis, you end up with a document that's far clearer and is much more flexible going forwards for when you need to revisit it to assess whether changes are needed. And you'll have heard me say, in both in this slide and the previous one, that this document we would consider to be incredibly important. Now, why is that? I think, well, if you refine it down, if you're not able to populate the matrix, you fundamentally do not have a good steer on the transactions in play. And without being able to map the transactions correctly, regardless of how good kind of the form of intercompany agreement is that you use, it will ultimately either be defective or you will end up in a situation where there are other transactions occurring which have not been properly documented. And that's one of the biggest benefits of mapping out the transactions and weighing them against the TP policies, that quite often we will identify additional transactions, and sometimes they need to be priced separately, and sometimes they need to be delineated as well into an additional intercompany agreement. So it's really clear, a really clear way of getting a good steer on what the position is. And even if the situation is actually, yes, well, you have identified a new transaction, but actually it's de minimis, doesn't need to be priced, it's still important to keep that on your radar in case that position changes going forwards.
And just to add to that, and as you know, gather, we are huge fans of going through the discipline of nailing down the transactions. The kind of things that get flushed out with this document is sometimes in transfer pricing reports or documentation. For example, it may refer to distribution services, something like that. And that may be vague or ambiguous as we go, well, what is actually the nature of the transaction? Who is doing what to whom, as it were? And if a distributor is in reality a reseller, so it's actually reselling the goods or services or whatever, then the nature of the transaction may be, from an economic perspective, it may be similar to the provision of services to the principal. But actually, it's a distribution transaction. It's a buy-sell transaction, or it's an appointment of the license. And just being clear on how the transaction actually maps onto the reality of how the group works legally and commercially is so fundamental to actually understanding how it needs to be described. So going back to some of the common mistakes that we see in agreements, we see agreements that actually don't fit the legal fact pattern, actually don't fit the contractual model of how the group actually works. And that's because we can only guess what's happened is, well, actually the TP analysis has not been very rigorous, you might say, and maybe a template has been provided and it doesn't actually fit, doesn't actually describe what's happened. And so that's why we're so keen on using this as a starting point. So the first thing that we'll do when we start a new project is, yes, we'll review the background, and yes, we'll piggyback on the existing transfer pricing work as much as possible. But then we'll repeat back our understanding of how the transaction, or what the nature of the transactions is from a legal perspective in this matrix, and then we'll reconfirm it with the corporate and with the TP advisor. And it's a far more robust process and avoids the necessity for backtracking. So that's why we're so vehemently in favor of using this and actually slowing down. As Andrew said, before you set pen to paper on the drafting, let's get this totally nailed down so we understand what we're doing here. So I'm going to talk about practicalities of, well, what do you do in your group? Because a lot of groups are facing a situation, maybe they've got some agreements in place, maybe they've got agreements in place for all their intercompany transactions, but they were last reviewed 5 years ago. And given that tax and transfer pricing functions are working in multiple periods at the same time, where do you actually start? So if you imagine that we're talking about a group with a calendar year, financial year. So here we are in 2025. The question is, what do we do? Which financial year do we look at? And the urgency and the priority is going to depend on the risk profile. But generally speaking, where we would start is the prior year, so 2024. And so what we're trying to do here is, ideally before the end of this year, 2025, is make sure that all the intercompany transactions are actually documented in respect of that financial year, 2024, in a way that aligns and supports the transfer pricing analysis. So the action is, let's go and confirm the transactions matrix. Let's nail that down. Let's identify the stakeholders that matter to the group. So that may include withholding taxes, VAT, regulatory compliance, and so on. It means actually doing that cross-check. So checking your existing agreements for coverage. So do they actually cover all the intercompany transactions? Or are there any transactions? You might find that there are agreements in place for transactions that actually don't exist anymore. So you're checking for coverage, and you're also checking for alignment. And the alignment is in 4 key areas. So one, the nature of the transaction. Does the intercompany agreement match the TP analysis as regards what is the transaction about? It's about the risk allocation. Does the agreement match what the TP analysis says about which entities assume which risks? We're looking for alignment with the pricing. Is the agreement actually up to date as regards the current pricing that is applied and was applied for that period? And then finally, as regards ownership of intangibles. So here we're fixing gaps and defects. Now, as Andrew said, it's always difficult when you're trying to work retrospectively, because in this situation, we can't rewrite the history, and we certainly can't create a fraud. But to the extent that we can fix gaps and defects, it is far better to do that now rather than sometime in the future when, number one, you may lack the corporate memory as to what actually happened. And number two, the further you leave this unremedied, the bigger the window, the bigger the risks are that you're accumulating. So that means that, yes, you are retrofitting your agreements as much as you can. And yes, you can't create a fraud. So where we are creating updated agreements, wherever possible, we are reciting the fact that what we're documenting now memorializes the actual conduct of the parties during that period. And so we are reflecting what was actually happening on the ground. To the extent that obviously there's a discrepancy between the TP analysis and the actual operations, then there's a bigger issue that needs to be fixed here, but at least you have identified that up front. And as I said, in terms of timing, really you want to do that by the end of, well, ideally it would be in advance, so during 2023 or 2024 itself, but you have to do what you can do right now. And generally speaking, we would be hesitant about backdating more than one financial period because it just creates more complications in terms of financial reporting and so on. So that would be the typical work plan in relation to 2024 to bring yourself into a compliant position, or as compliant as you can be. That means that if you move on to the second box, so in relation to transactions in the current year, 2025, obviously you're working with the basis that you've already created. You're reviewing, well, what changes to the transactions have there been? And that may include new transactions or updates to pricing. We're creating updated agreements. And to the extent that we're changing the arrangements, then we're documenting the rationale for those changes. So that was one of the key learnings from recent cases like SingTel and Sketches, which is that the corporate group in those cases had failed to document in any way what was the commercial rationale for the new or the changed arrangements. And that's why, as Andrew mentioned, it's so important to reflect that in the briefing notes, and so important to reflect that in actually the commerciality of the new agreements that are being put in place. So in relation to the current year, 2025, ideally, because we're transitioning to a situation of contemporaneous agreements, ideally you want to do that fixing work before the end of this financial year. In any event, you'll want to get this done before the corporation tax returns and financial statements are finalized for this current financial year, because obviously what you don't want to be is in a situation where you're doing the rectifying work in relation to the agreement, and actually as a result you're having to question your positions in relation to corporation tax returns that have already been filed. And then at the same time, what you're doing in respect of the next financial year, so 2026, you want to be anticipating what changes will you want to take place as from 1st of January 2026 and implements accordingly. And it may feel like this is a big ask, But unfortunately, this is the way that the transfer pricing environment is right now. So if you look, for example, at the UK guidance on transfer pricing that was issued in September last year, what it really emphasized was firstly that UK risk leads, in other words, those individuals who are actually signing off on transfer pricing documentation or corporation tax returns in the UK, are actually expected to involve themselves and understand what is going on. In other words, they can't just say, well, it was outsourced to someone else, or it was head office that prepared all this. I've got no idea. It's actually on them to inform themselves. So number one. Number two is the consistent focus in that guidance to the timeline, the process. In other words, it's about planning, designing in advance commercially rational transactions, implementing them in advance, and then reporting on them accurately. Andrew, you raised your hand. Was that intentional, or was it just?
It was not. Sorry, apologies. I was checking the Q&A to make sure we hadn't had any questions.
Fantastic. Okay. And so that is the reality of the challenge that we're all facing, and transfer pricing teams in particular, which is they're working in 3 time zones at the same time. So the year just gone, the current year, the next year, and at the same time firefighting and dealing with inquiries in relation to historic periods. So my sympathy and commiserations to all of you who have taken up that challenge. And our task is to help make that transition to the most robust situation that you can achieve it. And then box 4 is, what ongoing systems do you want to create and start to implement? Well, number one, if you don't have it already, a fundamental requirement is a central repository of intercompany agreements. We still come across groups who manage their agreements on a local basis, on a regional basis, which means that they have pretty much zero oversight on what is being said in those agreements. It is not a comfortable position to be in. Next thing is to be clear on roles and responsibilities. So who within the group, which function, which individual within the group is actually responsible for keeping intercompany agreements updated. Generally speaking, it tends to be the tax team, because it's the tax team that bears the downside risk of that. In other words, the tax consequences. The exception, I guess, would be regulated groups, where it tends to be that the compliance function has, if you like, ownership of the agreements, because they are a ticket to play from a regulatory perspective. And therefore, the task of the transfer pricing and tax function is actually to inform themselves as to the existence and the terms of those agreements, and to exercise influence in making sure that they are actually aligned with the transfer pricing documentation and vice versa, and they contain the necessary functionality which is required from a transfer pricing and OECD perspective. Diarized review points. In other words, usually we would recommend reviewing at least twice a year, depending on the activity levels of your group. In other words, that the regular review points to say, well, has anything changed? What do we need to update, and what do we need to anticipate? And what are the protocols for updating agreements and ensuring that intercompany book entries align with intercompany agreements? So nowadays we come across a lot of groups that are very hot on this, and will have the internal rule that no intercompany charges can actually be booked unless those charges are supported by a valid intercompany agreement, and actually the book entries reference the agreement numbers and so on. And then obviously protocols for ensuring that entity accounts, corporation tax returns, and TP documentation aligns with ICAs. So I know that many of you will be familiar with the IRS guidance on best practices. And one of the aspects of that guidance is that transfer pricing documentation needs to explain why and how the purported risk allocation is consistent with the agreement. So it's not just agreements need to align with TP documentation, it's actually the documentation needs to faithfully reflect the reality of how the group operated, including the reality of the agreement in force. So that's a rundown of where you might start. Obviously, resourcing is possibly an issue, and that means that when faced with this kind of matrix, you'll need to prioritize which transaction types and which periods you need to focus on first. And that's very much going to depend on the particular group involved and specific sensitivities and its country profile. So just to explain how we help, various things that we do. So we provide ICA health checks. So that's what we call a traffic light review. So we will review an agreement or a sample agreement and check that against the relevant transfer pricing policies and give a report on alignment. Obviously, ICA drafting is something that we specialize in, and that can be just on an individual agreement like a CSA or a profit split agreement, or it can be the whole portfolio. Matrix design, so that process of actually identifying and mapping the transactions onto the legal agreements concerned. So that's a critical function. Global maintenance. So for a number of clients, we actually act as the outsourced provider in maintaining the portfolio of agreements and keeping them updated on a yearly basis. Restructuring projects. So this includes something that we've been involved in very, very recently, which was a major restructuring project involving an entirely new set of transactions and entities. So that's getting involved at the outset in terms of the choice of alternative legal approaches and how the transfer pricing analysis might fit into that. And then finally, we do provide toolkits and training to facilitate in-house teams who want to do this themselves. I can see we've got. Sorry,
carry on. I was just going to say we've got a little bit of time left just for some Q&A. If you'd like to put your questions in the chat, I will try and pick some out. Feel free to choose any of these questions or any of your own questions. Just while I'm giving you some time to write those questions, Paul, we obviously touched upon backdating agreements. You obviously referred to certain jurisdictions where it isn't viable, things like Germany. Do you want to maybe just talk about principally how backdating works in the kind of the correct way?
Yeah. So yeah, there is a wrong way and a right way. The right way is when we can genuinely say that we are memorializing now in an agreement an arrangement which has been actually operated in practice. Then the right way to do it is to create the agreement now to make sure that the terms of the agreement are aligned, obviously, with the actual operations in relation to the historic periods. We will have it signed and dated now. In other words, it would be dated 18 September 25 if we were doing it right now, but it would have a historic effective date, and it would recite the fact that the parties consider that what is being memorialized now correctly reflects the conduct of the parties in that relevant period. So that is what we consider to be the appropriate approach. And as we said before, where there are gaps, historic gaps, it's always better to fix them now in that way, even though it is not as robust as forward-looking agreements would be. You've still reduced your window risk and your extended risk considerably.
And we've had a question in. So, what type of tools does LCN provide in your toolkits to assist in-house TP and tax teams?
Fine. So we provide toolkits in the form of training. So we will do bespoke training sessions for in-house teams. Often that means bringing together the tax and the legal, maybe the regulatory teams, so that everyone is on the same page as to what is the nature of the challenge, what are the specific issues, and how to prioritize. So that's one way that we help. And we also provide toolkits in the form of template agreements for standard transaction types and the starting points agreements for more complex transaction types like CSAs and profit split. So if anyone is interested in that, please can reach out and we'll be very happy to provide details.
Perfect. And I think that probably takes us to time. Just before I hand back over to Paul, obviously really good to meet you all. To the person who said rapidly outdated and to the other person who said their ICAs are, quote, dodgy, please feel free to reach out if you'd like to chat those through. But back over to Paul.
Great. Yeah. And just to say thank you again to everyone who joined. We really appreciate your participation and your comments. We'll be in touch very shortly to share the slides. We look forward to seeing you next time. Thank you.